The S&P 500 distance stabilizer is not vol controlled. And that's a big point. It uses volatility budgeting. I love your sign in the back, systems work. Well, that's what we wanted to do, is how to bring in an S&P design where the system works.
Tom Haines is the EVP of Capital Markets and Index Solutions at Annexus. I remember when the FIA space was like a $62 billion industry. Now it's like 120, 125, I think, as of last year. So it's doubled. I don't think it has any signs of slowing up, essentially. But I think that's because a new market of advisors are now starting to recommend these.
Then the third metric isn't just the expectation of equity returns and bond returns, it's your own life. But how long are you going to live? If we're going to have all these revolutions with AI, quantum computing, biogenetics, all of these things, and sleep is going to allow us to live longer. So what an FIA does is a few things. It provides us the comfort of 100% downside protection. So the knowing that you can get to the ability of guaranteed lifetime income, a bond can't do that. But now you got in New York, every bank, be it like 3 or 4 Japanese banks, 3 or 4 Canadians, all the European banks, all the US banks. I probably have like 15, 16 banks calling us up with designs. What I caution is
systems work, people fail. Welcome to InsureMark's Advisor Mentorship Podcast with Vice President Jeremy Hauser.
Welcome back to this week's episode of the Advisor Mentorship Podcast. I'm your host, Jeremy Hauser. Excited to bring this one to each and every one of you. The industry has been off to a start here in 2026. Definitely had some incredible guests here over the last couple of months. Wanted to bring someone back. I haven't had Tom Haines on since February or so of 2025. So how the market in the space changes a lot. And for those of you that know, Tom Haines is the EVP of Capital Markets and Index Solutions at Annexus. So how are we doing today, Tom?
very good. Thank you so much for inviting me on, Jeremy. And to all the advisors listening, I hope you're all doing well and getting ready for the big 250th anniversary here.
That's right. That's right. Yeah. My goodness. A lot going on for, our country as well too. And I think, there's so many different ways to start off and talk about for today's episode. But before we dive into some questions, so I want to take people back. So this is a three-peat here. So you've been on a couple of times here for the show itself. You started in 2024. We had you on and you talked about due diligence with indexes, these volatility controlled indexes, a really good deep dive. I highly recommend for the listener to check out a previous episode with you on it, talking about due diligence in the index space. The last one we did last year, you went into a deep dive about forecasting, talking about the index strategies moving forward. How do you pick the right ones? What's the resources and tools? So this one will be a good conversation here today, especially lining up the listener into what you're going to talk a little bit more about. And that's, looking at all the resources your team has put together when it comes to not just brand recognized names, but the academia that goes into y'all's products. So how do you start? So how does Tom Haines start to actually pick the design and update these FIAs as time goes on with all the research your team has put together?
The journey is really being committed on that diligence process. If we're going to walk off that process or turn a blind eye, we think the whole thing falls apart. And really what that has evolved into, though, I'm now 9 years at Annexus, is from an index diligence process to a portfolio diligence process. Because if we were just thinking about allocating to one index, you're taking a bet. If you want to do bets, there's other podcasts that talk prediction markets and sportsbook apps and so forth. But in the retirement planning business, it's diversification. And yes, the portfolio of assets that you, your client, the advisor is working with includes equities, maybe some alternatives. But the alternative that we bring to the table is the index annuity, right? The comfort of the 100% downside protection, upside, where you then can have other aspects like guaranteed lifetime income, a legacy plan, retirement riders. But from the accumulation engine, how we're going to maximize in this current rate environment a 5-6% return without taking a bet. And that is a journey of building out a portfolio. So if we're going to have a portfolio of assets, how within the index annuity we build a portfolio of indices so that on a given year there's a zig, on a given year there's a zag. that drive to maximize that probability. And that journey and persistency of working with our insurance company partners year by year in out to then get an index added to complement the portfolio. So that'll include access to new asset classes like going global, which we'll talk about hopefully today, but then even revisiting the S&P 500, how to bring a better S&P 500. And that's one of the things we also are so proud about with our recent partnership with Standard & Poor's and Societe Generale on the S&P 500 Distance Stabilizer Index, so that now we finally have an S&P design in there that we're not going to apologize about. Bringing that all together, though, is the portfolio approach. And as long as you keep to the journey of diligence, making sure the strategies are based upon research, not off of an illustration, making sure that the index is built to work on a go-forward basis, not an illustration basis, and then making sure that this isn't just an academic exercise, but it's implementable. To have strong participation rates, but much more importantly, stable renewal rates, so then you're not apologizing to your client in confusion about why renewal rates have dropped. Those are the ingredients that bring us to that index selection to then say, well, how does that index complement other indices to fulfill the portfolio?
And so it's not one size fits all. So I know just work with y'all's team for over a decade now. I know the index due diligence process, for some reason, I don't know what it is, but for some reason, at least the ones that you guys are partnered with, the renewal integrity is actually there. That is something that I can firsthand see from afar. You can see from the really just from my advisors' experiences of just the due diligence of having renewals that are not just completely half the rate, halfway into a contract, all of a sudden you had 100% par rate, now it's down to 50. That's more of what you're talking about around the due diligence of like not just picking the index, but also being able to price it with the right carrier.
The implementation, absolutely. And that's really a three-part process. Unlike a lot of other firms out there, insurance companies included, we're not creating a product where we come out with high teaser rates and then put you in the Roach Motel, your client in the Roach Motel, then at 4 or 5 years in, we dock the rate. That's intentional deception, and they're not our partners. That's not our business model. We're not trying to say, well, we can forecast where options are going to go 4, 5, 6 years from now. You really think so? Let's look at what the options market dictates today. So what we'll do is say, what the option price we can afford today, let's budget for that so that the renewals will be stable during the surrender period. Not 30, 40 years out, but during the surrender period. That's number one. Number two, thanks to you, the advisor, right? You're the purchasing power. You give us that purchasing power. Last year, we sent Wall Street over $30 billion of options notional. And by me being here in North Jersey representing us, I'm the only person in New York that does this and represents the insurance industry for us. We get not just the first look at new indices, but we're getting honest and transparent option pricing mechanisms and contracts in place with our insurance company partners that allows for Wall Street to provide that stability. And that's part of our process there. And then with the integrity of those insurance company partners that we have, A+ rated insurers, you see that demonstration of that. It's also, though, one of the reasons we've avoided the S&P 500 price return, right? The S&P 500 price return for so many years has been a rate renewal roller coaster. And I know it has done so well for 69 years of being the benchmark for the asset management community. But it wasn't until really recently we finally had an S&P design that brought that rate renewal stability.
North American has redesigned their award-winning Secure Horizon suite of FIAs to be more resilient in volatile markets. And effective March 10th, they added the S&P 500 Distance Stabilizer Index. This measures volatility over multiple recent time periods, which allows for flexibility to navigate short-term spikes and increase exposure during subsequent market rebounds. It aims to track the pure S&P 500 without a fixed volatility target, bonds, or commodities. It's available on the 1-year, the 2-year, and also their very popular laddering strategy. They have also recently added the straight S&P 500 annual point-to-point cap strategy to this suite of products. Not that commissions are important, but North American is also running a 1% commission on all of the Secure Horizon FIAs effective March 1st. When is the end date of this special, you may be asking? Well, at this point, there is no end date. So take advantage of this opportunity now. For more information on the North American suite of products, feel free to go to www.insuremarkamp.com/J Hauser and click on Learn More. Yeah, and I can tell you firsthand. I mean, literally, it's funny. I was talking on one of the mastermind calls I did with the advisors back in May. So April was an interesting month for this year, and that was more of becoming a believer. I would say a lot of the advisors that were on the call. So that S&P distance stabilizer, and I believe it's now on multiple companies that you guys offer. So literally in April, and you probably know the stats better than me, the S&P bounced back from March into the end of April, roughly just purely the S&P 500, a little over 10%. But sure enough, it was just unique to have a volatility controlled index that actually mirrored that actual return and did over 10% in just April. Not going to do that all the time, but that more so at least gave us a nudge of like, you know what? Annexus may be right. That 93% correlation. So talk a little bit about more of, it seems like it took a while to get something out there on the market, but how were y'all able to really mirror something and felt confident enough to launch?
Absolutely. Let me just correct you one point there. This index, the S&P 500 distance stabilizer, is not vol controlled.
Oh, it's not. Okay.
And that's a big point. It uses volatility budgeting. And I love your sign in the back, systems work. Well, that's what we wanted to do, is how to bring in an S&P design where the system works. And what we had seen over the last 9 or 10 years, we've talked already about the S&P 500 rate renewal roller coaster. Because of higher volatility, because of higher interest rates, because of lower dividend yield expectations, we've seen traditional S&P cap strategies go down, S&P par strategies go down in renewal rates. Yes, we've had the best S&P decade in a long time, but it still left clients with a 5.5% return, which was good, but shrugging their shoulders. Well, what happened? And then you add all the shenanigans of insurance companies and such lowering renewal rates intentionally, trying to get you into the product. So how do we bring an S&P design? And vol control wasn't going to be the right answer. We utilize vol control with our academic portfolio because it allows us then to bring in the mindset and access to asset classes of our academic elite and strategies to diversify from S&P. Otherwise, we wouldn't be able to bring them to the table, and then we wouldn't be able to have some of the performance we see in global strategies right now, which has been phenomenal. So there's a place for it, but if you're taking the one S&P 500, vol controlling, the problem with that is it was taking us always out of V-shaped markets. And there was attempts to say, well, we can go intraday. Well, Truth Social has intraday V-shaped not market situations now for us. So that doesn't work. Having hidden caps, hidden leverage, a lot of different implementations that we just passed on. We said, no thanks, not what we needed. And then I was so fortunate to be asked to come in to see Societe Generale early March of 2025. They said, Tom, can you come into the city? We have an S&P design to show you. And sure enough, they said, are you aware of what we've done with hedge funds 20 years ago on what we call timer strategies? As a matter of fact, I am. What happened then in 07, 08, 09, hedge funds did not want to overpay for the S&P. Mm-hmm. Sounds familiar? Then the other situation that the hedge fund ran into was a year goes by, they have to renew into another option term, lower exposure. The same problems you and your client face today with an S&P design, they faced then. And Societe Generale said, if we can have an option where we're not overpaying for the S&P 500, but rather we're budgeting for it, not vol controlling, budgeting. Think about utility budgeting. It'll allow you not to overpay and allow you to power through the market. That was so successful, that implementation in that period of high market volatility, which was for years. They won numerous global awards, that Deal House of the Year, that are still online, you could see to this day. Fast forward now, Societe Generale is in the FIA market. We have indices with them. They're out there. And they said, how do we bring that know-how and prowess of timer strategies, budgeting, within an S&P design? And what they did was much more robust than I had ever saw. We at Annexus were working on a design for about 2.5 years And what they did was a much superior implementation of that. A system, not a bet, and not a forecast bet on thinking they could predict volatility the next week or two. No. Powering through budgeting. And we were proud enough to then present that to S&P. Through 2025, we did a diligence process with S&P. We did our own diligence, brought in our insurance partners. And I'm proud to say September 12th, 2025, we launched the S&P 500 Distance Stabilizer Index, exclusive to Annexus. And for the first time in this year, we are proud to say we're hitting our 20th anniversary live in the market with a product. And Shoremark was one of our original partners, so we're grateful for the partnership. Was bringing that on to all of our designs. You see it now in the market today with Athene, Americo, and North American. Different crediting permutations in some situations, and the product provides a different solution, which we can get into. But that was allowing us to finally have an S&P design. And we saw when we were doing our diligence last year, we were a month in and Liberation Day hit. Right? And we saw everything falling apart in these vol control strategies. Some of them took, let's say a gardening leave all the way out to the summertime. Others were still like in the V-shaped market, just stuck. And we saw some renewal rate inconsistencies, which you could imagine in April of 2025. By April 2025, we were studying it real time because we're implementing this thing with diligence. It got up to about an 80-90% allocation, 88% allocation to the S&P 500. And what gave us a comfort when we came to market to say, yeah, we're going to come out with an S&P design that can give you 100% capture ratio of the S&P 500 on average, not day in, day out. And we saw a really good proof point. And then now we launch, and to your point, we saw the same situations, right? With the yings and yangs of market volatility between global unrest, AI evaluations, so many things to consider, interest rates and inflation, which are related to the other points. We saw the market you just experienced, an S&P 500 distance stabilizer powered through it. It powered through it based on that budgeting design. So I'm proud to say that versus an S&P design, you're going to be getting 3 or 4% higher returns right now. And when we look at our competitor league tables of S&P designs over the last year, yes, I realize some back testing, but we won't launch September 12th. We're hands down, the S&P 500 distance stabilizer is outperforming the vol-controlled implementations of S&P, and it's outperforming S&P. And what we're happy about is it's finally us able to anchor into an S&P design, not to take a bet on it, but to complement it with our academic portfolio.
Retirement isn't built in a day. It's built on a strong foundation. Talcott's fixed index annuities help protect against market downturns while offering real growth potential. The Everguard Assurance delivers guaranteed income you can count on, and the Everguard Aspire offers strong growth potential with competitive rates and caps, plus a no-fee bonus to help clients stay strong all the way through the age of 85. It's all part of a commitment to help advisors and clients move forward with confidence. Talcott, a foundation you can depend on, a trusted partner for what's next. If you would like more information, go to talcott.com and make sure you learn more. Once again, that's Talcott, TALCOTT.com. And that's the thing, right? So you have the academic portfolio, you got incredible research. I remember back in like 2020 when you guys brought this to us, the forecasting report, the quarterly report, Schiller's team was putting out there, him and I believe Lawrence Black as well. So when advisors, since 2020, they kept saying, don't do S&P, or not don't do S&P, but
go global.
You should probably start going global. A lot of people were like, I don't get it. Why would I ever do that? But as time goes on, those white papers seem to be gold as the results are.
And it has. And Bob Schiller, and I know you recently had Ben, who's continuing with his brother to work with his dad on the Schiller index business, and he's at Brandeis University. He did a great job on your show. Is Bob highlighted in 2018, global valuations were showing better opportunities in the U.S. market. And when Bob sat us down up in New Haven at the time, he said, diversify with U.S. Schiller, diversify, not replace. And he highlights, Bob is the first to say that CAPE is awful at short-term forecasts. He would not want you to allocate short term. But from a long-term mechanism, forecasting process, it is demonstrated time in, time out, not just in the US market, but around the world, it tends to work. And when we launched the Global Schiller, to your point, 2.6% illustration in our Athene product 2019. Your mentor and boss, Steve, came up to us at break at our partners meeting and said, as Tom left wing, as he woke, I had other people, what has Annexus done? And who gets the last laugh in 2026? Bob Schiller. It's been the best performing FIA product return in the market. Over the last year, some clients are getting 38, I had a call recently, 40% product returns. On an annualized basis, 5, 6, 7 years out, clients are getting 13% returns. Phenomenal. Now, what I would highlight about that, let's not get enamored with that return. I can say US Schiller Index has done zeros over the last few years as well. Siegel, yes, best performer in 22. But when you average it out, you're improving the consistency of those returns. And to Bob's point on global markets, it's a compliment. When you sit down with your client, we all, I think, can believe here on the call, you, the advisor too, America is the best country in the world, but that doesn't mean it's the best valuation opportunity. And we're here in diversification, and it's slow. We were getting out to market, especially coming out of the pandemic. The historical numbers were showing near 0, 2% for global markets, but the forecast was showing 6. And as we bring our advisors into New York now, it's really funny. We see the last 10 showing 6%. And I tell them, if you met me 6 years ago and what you just said, the 6 was on the forecast category and those are 0. Now we continue to see global markets having an opportunity, hence the need for diversification.
So talk a little bit more about what you just mentioned, especially how do advisors know how to blend them accordingly, right? So there's a lot of these products out there, not just Annexus, other products too, but if we just focus on really y'all's suite of the Annexus products, majority, I want to say, if not all the products, they have an S&P component in there as a strategy that they can allocate to as an advisor. But then they have these vol-controlled indexes, some domestic, maybe some of the products have global strategies as well. So what is the balance? How do they talk about some of the resources you guys have started to utilize to help the advisor figure out how do we allocate these things?
Absolutely. So for the last 3.5 years now, we've been really a proponent of turning to index standard for their blend reports. Again, that's a long-term forecast-driven approach, but that's our compass to maximizing the goal, 5, 6% long-term returns, not annual performance, because it's long-term forecast, as we just said, it's not going to be the best predictor of annual returns. But if you have a diversified portfolio, on a given year, if there's a zig, there's a zag, it should drive that consistency. So we've been a big proponent of that as our base, and that really will select indices that tend to have a lot of what we say the academic portfolio, the smart beta approaches, right? You're getting access to Cam Harvey, Siegel, SACA with media stats and looking at news media, all of that portfolio. And most of the index standard allocations that are updated quarterly do not include S&P 500, nor do they include S&P 500 distance stabilizer. And only our North American ladder does. And the reasoning why is the S&P for the next 10 years, the consensus of Wall Street analysts, and we're not next year's forecast, 10 years out, is around a 5.3%. So even with a stabilizer, right, that is aiming to capture 100%, you're not going to get that with 100% par. It might not do as well as some of the other forecasts long term.
Sure.
So we remember to tell people utilize index standard blend, but then S&P 500 is the U.S. anchor, and the S&P 500 distance stabilizer is that consistent way to capture the S&P without the rate renewal roller coaster. So we really advocate to people, take that blend. Stabilizer, we might see really strong S&P results in the next year or two. With AI and the phenomenal developments that we're seeing, it would be remiss to say, well, your clients, if we say, oh, don't worry, come back in 10 years, that's not a realistic experience. So having that S&P anchor through the stabilizer allows them to get benchmark exposure without the rate renewal roller coaster. And then you can anchor it with the rest with the index standard blend. If you have a client though, and they do not even want to fathom the academic portfolio, they're going to leave a lot of money on the table. And hopefully you and your community, you've built that trust that you can show them and tell the stories that we're talking about, like the Global Schiller story, right? The Cam Harvey work, the Ronnie Sackett, that they see the strength of that portfolio as the yin and yang. But if they can't get there, you do have the S&P 500 distant stabilizer. You could do that to meet the client where they're at. Or if you're doing managed money and you have so many other asset classes, you really just want to target one. However, we know that long-term, the forecast is actually lower in the market than the rest.
So, and that's something that's been interesting. So if you look back the last 3-4 years, I remember when the FIA space was like a $62 billion industry. Now it's like 120, 125, I think, as of last year. So it's doubled. I don't think it has any signs of slowing up, essentially. But I think that's because a new market of advisors are now starting to recommend these. So can you talk a little bit about, to the point of, yes, we've had some really good returns here as of late. The market's had some really good returns. But why are advisors looking at FIAs as a bond alternative and maybe even ETF alternative strategies?
Sure, absolutely. Well, if you look at the 60-40 portfolio, right? I've already said now with dividends, the S&P 500 for the next 10 years could be 7. And Ben on your podcast went through that, right? I know there's a lot of excitement and we're in a new revolution with AI, but if you look at the metrics that tend to be right, and he highlighted electricity, the railroads, computers, we've had major phenomenons before that changed the production of this country and the world. Just be cautious, right? So if you say that's anchored at 7 and we have expected bond returns corporate bond returns at a 5.5 with potential volatility there, there's a big question mark on inflation. What can you do there? Then the third metric isn't just the expectation of equity returns and bond returns. It's your own life, right? Yes, there's an expectation of inflation, but how long are you going to live? And if we're going to have, Cam Harvey talks about this at Duke, who's one of our index partners, if we're going to have all these revolutions with AI, quantum computing, biogenetics, you're going to get a better lifestyle. The access to getting better answers, and Ben highlighted with doctors, right? AI is going to be able to provide, not that we're going to have Dr. Claude, but a better prowess and innovation in financial chemical engineering for pharmaceuticals, access to better answers, robotics to do more precise surgeries. People are going to live longer. Understanding of diet and health, right? Handheld devices, all of these things, and sleep is going to allow us to live longer. Mm-hmm. And then when you look at that, the risk of the probability of a safe withdrawal rate of a 60-40 portfolio for someone living to 100, it's not near 4%. The risk of ruin is high. And yes, today, the probability of living to 100 is about 10%. But with those things, that revolution, if you believe in AI and biogenetics and what we're talking about, you're going to live longer. So what an FIA does is a few things. It provides us the comfort of 100% downside protection. So we're not at risk of the interest rate volatility based on uncertainties with inflation and policy and debt. Number one, provides a floor. Number two, it provides you other solutions that you might need, such as guaranteed lifetime income. Our nationwide FIA, the ability to have a 100-year-old mutual insurer that has leading guaranteed income, put the allocation in with the annuity for a few years, that's comforting. So knowing that you can get to the ability of guaranteed lifetime income, a bond can't do that. A bond can't do that. And as much as I have a lot of respect for Dr. Siegel, when you do the statistical analysis on a go-forward basis, 100% equity allocation, that's going to lead your safe withdrawal rates more like a 3.3%, unless you think you're getting in much higher equity returns. So that's not going to work, and that's a bet. So that's what the FIA does. Full downside protection and comfort to your sleeping point from an accumulation engine. Upside, though, that's going to give you the similar returns. We said 5-6% long-term returns, not every year. And then the other things, be it Social Security insurance, North American, be it lifetime income, be it the ability if you have a situation, you are in confinement, you need additional funds. Those are the things that a bond portfolio can never do and an FIA can bring. And that's where we're so happy. That's a piece within the portfolio, not the full replacement.
What if your clients could access one of the biggest investment trends of the decade without sacrificing the protection of fixed index annuities? With Ibexus, they can. Their newest index options provide access to crypto-linked growth potential through the fastest growing ETF in history, plus exposure to the world's most recognized U.S. equity index, the S&P 500, through an innovative volatility-controlled strategy. More innovation, more diversification, more opportunities to differentiate your practice. Contact Ibexus today and see what's next in fixed index annuities. And to that point, right? So Morningstar this year, 3.9% is that safe withdrawal rate according to Morningstar here for 2026. And, I'm having a lot of conversations with advisors, especially RIAs that are now looking at these fixed index annuities as just a solution to complement to especially their bond portfolio itself. That 3.9%, but the interesting study with Morningstar is that's with the 50-50 blend, and it's only a 30-year time frame. So that's not even guaranteed. And they have a 90% chance is what they're putting that number at. So it's not 100, it's a 90% chance if you pull 3.9% based off the Morningstar report from the portfolio that you'll have enough money there for the next 30 years. And so that's why, to what you just said about guaranteed income, advisors are now just looking for alternative solutions to, like, customers want guarantees. They want more stability. So it's interesting what you just referenced right there. And I think so if we go into the industry a little bit more in detail, because you guys have so much research, so much really like the thumb on the pulse of where the industry is going. Is there something you've seen of trends here over the last year that you think have helped the industry itself? Like when you look at your portfolio of indexes that have done really well, do you see something that you guys are very thrilled that you've moved forward with and it's executing? I know that this stabilizer, you talked about that, but anything else outside of just that specific index? Are there certain strategies that are working really well, and why are they working well?
The global markets, the comfort of knowing, and hence through this journey that we saw the index standard and capital market assumptions saying, go out, going global. We're finally seeing that through. Tremendous performance there. The S&P 500 distance stabilizer, correct. How to capture the S&P without that rate renewal roller coaster, without the confusion of other S&P designs. So those are the things that we anchored. The ability to add to the portfolio. And that's the other part of it that we've really been able to see. We knew within our smart beta portfolio how to bring in growth, but how to do that in a good way, in a prudent way. So working with Cam Harvey, for example, and research affiliates to have an index in our Athene academic portfolio now that allows you to go, the index is able to go prudent growth or value. Well, that was a void in the portfolio. So we were able to bring that. And then short term, to Bob's point, what ends up moving markets is narratives. But yet then we had no way to actually create an index to create narratives till we met Ronnie Satka. I had the fortunate of meeting Ronnie Satka, and I believe he's been on your show since 2018. But they were at Market Media Stats, his firm, were able to now implement a way with MSCI to navigate not just the equity market, but commodities, currencies, all these markets based on news. That's what moves markets short term. So we've been pleased to have that as a portfolio. So building out the portfolio, we're seeing that work because you see zeros in certain indices for sure, but then you see this amazing strength, hence the zigzag. Anchored with a stabilizer, and then going back to the realization, the FIA, we continue to see the need for guaranteed income we talked about. We talk about legacy planning. How many people don't have an ability to get life insurance? They want to bequeath something to their heirs. So those solutions, let's say the FER Max from Athene, and then the retirement rider we talked about as well. So these products overall, and couple it with just that simpler concepts like our Americo Benchmark Flex, that if the advisor only really can follow S&P, now they have about 8 different solutions tracking an S&P 500 designs. Really clear strategies. So it's the portfolio of FIAs, and then under the hood, the portfolio that we feel really good about into the market, and then continuing the education. The other part is we got peak 65 just happened. There's still a lot of money now. We got to get ready for peak 75. And then with the retirement refinance, we have seen a lot of clients move over, use that retirement refinance, which came out of the worst bond market in U.S. history, rising rates, to get into a product for the next 10 years that's competitive. We've seen a lot of that traction across the industry. But what we want to do at Annexus is continuing to show that even though there's new entrants coming into the FI market, a lot of shiny object entrants. And what we want to highlight is the consistency through our 20 years, through the hundreds of years of research of our academic portfolios, and then the strength, the bench of the Annexus insurance partners, be it a leading private equity company where their parent CEO, Mark Rowan's the most transparent of anyone in the industry, be it a 100-year-old mutual, be it an ESOP at North American, or a family company that has been very demonstrating for commitment, be Americo, that portfolio gives comfort that they'll deliver through their promise, as opposed to, you might have a good way to trade credit. Let's open up an insurance company. There's a little more to that. And we want with partners that have committed insurance companies, not just a quick credit trade in the market, to be our insurance partners.
New product alert. Revel One Financial is continuing to rev it up. At Revel One Financial, their mission is to revolutionize how people feel, think, and experience retirement solutions. They are bringing unmatched agility, speed, and innovation to the fixed annuity industry. And now Revel One Financial just announced their latest product launch, introducing a CumRev fixed index annuity with a 10% 7-year guaranteed cap rate with the S&P 500 1-year point-to-point index interest rate on the 7-year product. Rate subject to change at any time, but you heard that right. 10% cap on the S&P 500 guaranteed for the 7-year contract. A CumRev also has an index lock rider with 3 ways to lock in performance. Another launch, another leap forward. That's the Revel One Financial Cheetah Spirit, built for speed, designed to deliver. That's a really good breakdown of in a very short time. You just knocked out a really good segment right there. For the conversations you're having, are there like big name banks or asset managers you're seeing dive more into these volatility controlled indexes in the FIA space? Is that doing good for the space itself? I mean, it seems like we have a new vol index that comes out every other day in our space.
We continue to get selective, hence the diligence process, right?
Yeah.
What we have seen happen is a lot of people, just be open book about it, right? A lot of you, and I've talked to your advisors, they were frustrated coming off of 22, seeing lackluster results in 23, in some cases 24, right? I know there's been a big pivot to S&P. We hear a lot of the new shiny object S&P index designs, though. They're like, oh, we thought it was to do that. And it was, I had all the issues that we just talked about. And I don't want to belabor any specific index, hence why we're so proud about the budgeting approach of stabilizer. But now you got in New York, every bank, be it like 3 or 4 Japanese banks, 3 or 4 Canadians, all the European banks, all the US banks. I probably have like 15, 16 banks calling us up with designs. And what I caution is they're trying to set up shop. They got to get a deal. If they don't get a deal in New York City, they're out of business, and they're going to clamor to work with anyone. So if they're working with some small insurance company, just set up shop. I don't know what their track record is, right? Maybe the CEO has a lot of money. Maybe the CEO knows how to trade private credit, right? They're backed. But what's the delivery for commitment? A multi-generational commitment. That's really what we're looking at. And it is multi-generational. A lot of these cases, sometimes there's an enhanced death benefit, making sure that the spouse, the surviving children, they get access to that. And what we don't want to have happen is in an industry where there's chasing of shiny objects by both banks that don't have the commitment of demonstration of decades of being in the U.S. marketplace to support a financial advisor, or as well as the insurance company. So we're so blessed with our academic partners that are partnering up with major banks. Be it Cam Harvey and his partnership with Goldman Sachs, or MSCI and Ronnie Satka, and that index that we've launched now with, Morgan Stanley was very involved, or Societe Generale that has been a committed partner here in the U.S. markets, bringing their prowess and partnering with an S&P. So that is what we see as the right approach. Not that you can't be an entrepreneurial startup. I don't want to say that. Annexus was an entrepreneurial startup at some point. Shore was, in the late 1970s when InsureMark was started. But the point is the commitment that we know that for the next 10, 20, 30 years, we have the stability. And that's what we have, as opposed to running over a shiny object trying to make a buck in 2027.
Steve's going to make you feel bad for aging him like that. It was 83 when we started, not the 70s. But in the same breath.
A little bit.
I'm joking. But no, that's really good. And actually, true story. So literally earlier this week, and it's the sad part of the industry, but the very comforting part of the industry too. One of my advisors just had a customer who, for the last, they had a policy that was about 3.5 years old, or give or take, about 2022 policy. It was actually a Annexus product. That same individual also had another Annexus product that was roughly about 16 months old, give or take. Both those products have done really well. Unfortunately, the spouse, to your conversation here, this individual ended up passing away. So passed away earlier this month. So they're now going to be moving the assets into the wife's name, but they're also going to be looking now, because of the better interest rate environment. So they're looking for a strategy, but the goals have changed because, you lose the spouse. So now we need to start thinking more about not just the spouse themselves moving forward as the wife, but also for the kids. And so having the right products, having daily tracking is very beneficial, because literally she was coming up on a certain time frame where she would not have gotten any interest credited up to a certain time frame. So it's interesting. You mentioned not just due diligence of picking the asset allocation or the banks that you're choosing, but it's also, there's unique designs that are built into the products that I think that the really affluent advisors, like, they assume that this is how these products work, but not all products work that way. That would have been a catastrophe, because literally we had, like, in I think 15 months or so, it was about 13% return. So that would have just been wiped away if it wasn't tracking values daily. So just interesting.
Thanks for sharing that. I'm sorry for the advisors listening for their clients' loss.
Yeah. But at the same breath though, so that's the benefit of this industry, and what the real actual scenarios of, yes, we talk about products, but I mean, literally families are relying on a lot of the due diligence that teams like you guys are doing to make sure their companies or the assets are actually growing. And so, like, today itself, so if we actually go back into also for the fixed index annuity space, what are you seeing? So in today's market, are there strategies right now that you think are truly innovative? You mentioned intraday, but I don't think you guys are on that boat yet. Are there certain things in the space that you're thinking are very intriguing, and you're starting to say, hey, that's definitely something that is moving the industry forward?
I think what we have right now is what we embarked on, and the refreshes that we've made, since you last had me on in February, to build out the academic portfolio. I know a lot of your clients use a lot of the Athene BCA to build out that academic portfolio, which isn't just about having the Mount Rushmore of academic elite, but to bring in the consistency of different return profiles. We're so committed to that. The S&P 500 distance stabilizer, continue to be relevant when leading on bonus products. And then from the benefits of the product, as we said, we see the strength that we currently have. We feel really blessed that the portfolio is there. We're not at a point really to chase any shiny objects. What we've been able to do is push Wall Street, not for shiny objects, but for things that are overdue. So, for example, we recently launched a new index annuity, the FIA, the Benchmark Flex from America. It was the first to ever put in a locked cap ladder design. So if you think about a cap product, it's a 1-year cap, a teaser rate's 10%, the Roach Motel, you're in 4.5 years. We've talked about that, right? Guaranteed. But how do you bring something where the caps are legally guaranteed through the surrender period, and it's not a 7.5%? And we at Annexus have always shown you the benefit of multi-year. We talk about Liberation Day. You get out of that and you have a 7% cap. Well, the market's ripping through. Now you're capped down. So our lock cap ladder, and we were the first to bring a ladder design to the market in North America at the end of 21. We did it with S&P. We did it to 500. We did it capped. So currently, the product can show an 8% 1-year cap all the way out to 40% 5-year cap. And the cadence that, 20% of the the credits will come through, and the renewal is guaranteed. So you're not going to have a rate renewal apology. You know you're going to be able to get a cadence of crediting. You get the benefit of the upside. That is something we worked through with the banks for a few years, two in particular, and we're really proud to say we're able to bring that to market. So those are the things that we continue to embark on, where we push Wall Street for what the client should have, not what some French quant at the investment bank thinks that Wall Street needs for the client, because they don't know. They don't know. You're sitting there with the client. And that's one of my findings. I tend to really demonstrate when we work with the Wall Street banks to seek that solution for what an American retiree needs. This is not a financial engineering marvel of exercise here. It's a retirement solution.
What do you think advisors looking around the corner here in the FIA space? What are they not talking about yet that you think they should start talking about when it comes to FIAs?
I actually think we have a pretty good handle on peak 65, right, and preparing for retirement. But we had Annexus, and we've done a great job, I think, overall the industry for various reasons, but it was pretty evident on the great retirement refinance. Right? That was a term that my colleague Eric Denham coined, with all the bonus products to get, to your point, more competitive allocation since rates ran up. The next chapter, though, is, as we look at the baby boomer, is peak 75. I mentioned a few moments ago, and the thought process says, the client doesn't need an FIA anymore. They're 70 years old. What happens when RMD starts coming out? And if in a situation you have a client, they're not using all their income RMDs, please use QCDs, right? A lot of our products, the insurers are able to pay the QCD to charity. That's not something we talk about enough. And I think it's really comforting it's a win-win-win. It's a win that the charity benefits the policyholder who wants to help their charity, be it their faith-based charity, hospital, or educational alma mater. They're able to help out. And it's something the insurance company helps out. So that's a good thing that we have to be thinking about. But then let's say there's still additional RMDs. And the client's like, well, I don't know where to put the money. Interest rates aren't high enough. The money market accounts aren't that attractive. We talked about the volatility of the bond market. So what is the suitable product? Maybe it's a shorter surrender period. Let's say the person's in their late 70s. Having a 6-year product, that might be a suitable way then that they can have 100% downside protection and moderate upside from an accumulation engine to take into a taxable account to get that tax deferral. And then they can figure out things later and now in their later 80s. That's going to be the next, I think, wave that we're completing the whole bands. So how to support Generation X as they retire and they begin to receive from their families, their parents, the biggest generational movement of income, of assets that we've seen ever, right? To then the older part of the baby boomers that they're managing their portfolio. And an FIA fits on both sides of that.
Oh, very good. Very wise, as always. As we wrap it up, anything we missed or any final thoughts from Sir Tom?
Not at all. What we want you to do, hopefully, out there is with your clients that they can enjoy their sleeping point. So as we're into summer, no matter where you're in the U.S., that they're able to be time with their families. So as we have so much noise in the market, and a lot's really exciting with this whole AI revolution, but a lot of the geopolitical considerations, inflation, that they know a part of their portfolio is protected, that they can enjoy and get some nice sleep at night. So they're back out there with their families and enjoying the summer. And that's the goal of retirement planning.
Mm-hmm. Couldn't agree more. Yeah, great stuff, Tom. As always, thank you for coming on and diving in. Hopefully there is not a Dr. Claude. That made me laugh. I didn't listen to what you said after that. You had me chuckling to myself.
Well, we're talking about biogenetics and growth there. So you're on a Claude marketer, right? I don't think that's going to happen either. So you should use it, but it won't replace you, I don't think. So Jeremy, thank you so much for having me on. To all the advisors, thank you for taking time to listen to us too today.
Yeah, no, appreciate it. And like Tom said, thank you to the listener for tuning in. Make sure to subscribe on your favorite listening device to the Advisor Mentorship Podcast, and also subscribe to our YouTube channel at Jeremy Hauser AMP. And remember, as you share this episode with a friend or a colleague in a world full of betas, be an alpha.